When you take out a loan on a home, and most mortgage calculators are built for home mortgages, it's very simple. You have a loan amount, you have an interest rate, and how many years you divide your loan over. Amortization. Amortization calculates over how many years could I take a loan and make what consistent payments for all those years should my balance be zero at the end. So if someone takes a 15-year loan in the house, it's very simple. 15 years, you're done. 30 years, 30. But if you really think about it, the way math should really work, every month your payment should be the highest in the beginning and shrink over time. Because let's say let's go a high example. You borrow $1 million from someone over 10 years at 10% interest. The first year, you owe them $100,000 to pay back the loan, plus $100,000 interest. Year two, you want to pay back $100,000, so $90,000 interest. You only have $900,000 balance. Next year, 180, 170, 160, and you're done. That's crazy. No, it's the opposite. I buy a building, I have the least cash flow today. Over time, I make more money.
Right.
Amortization, whoever figured out the amortization schedule, and on the app there's a button there to see the breakout how it works.
Nice.
The amortization schedule calculates what payments would have to make that'll be even throughout the whole life of the loan. Okay. So the same payment every day. So if you put in an interest rate and you put an amortization, the difference by a commercial loan is that most commercial loans are not fixed for the life of the loan. So it's two separate discussions. On a home, it's simple. 15-year amortization. 30-year, 30. That means a 30-30. 30 years already fixed and divided by 30 years. For commercial, almost every loan is somewhere between 5, 7, and 10 years. Sometimes only 3 years. It's fixed. And then when the term is over, you got to refinance. So
Refinance means renegotiate my rate.
Renegotiate your rate to go to a new bank. You have to pay back. The bank's only committing to stay with you for that period of time at that interest rate. And then it's a new discussion at that time. Sometimes there's options, but let's keep it for the purpose of your calculations. But to compare apples to apple, you want to see how many years the bank commit to you. 5 years, 5-year term on a 30-year amortization.
So that's amortization, just the math of how I pay.
So that's you're not going to have to pay back the loan over 5 years. You make a payment of 6.25%.
Right.
But at the end of month number 60, 5 years, 12 months a year, your balance, you're going to have to pay back the loan at that point, whatever the balance is. So the first apples to apples to compare, if you may have an offer from one bank at 6.25 for 5 years, another bank is willing to sell it at 7 years for 6.25. If you think that interest rates are going in one direction, you'd rather lock in for longer. If you think interest is going in another direction, you'd rather take a shorter loan. So it's part of the negotiation. But factually, the reason why it's important to be able to put in here what your term is and amortization is because this is really crucial to understand, is that when you want to figure out your total returns on your money, part of it is to figure out in 5 years from now, what's my balance going to be? In 7 years, what's my balance going to be? So when you calculate, you're going to keep this building for the next 10 years, but after 5 years, you're going to refinance. And you can make assumptions what you can do in 5 years, and you want to know if you sell the building, what your profit is. You're taking out a loan of $78 million today. What's your balance at the end of 5 years? Now, interest only means I only pay interest. That would mean at the end of the 5 years, what's your balance? The same as you started.
Perfect.
But if you took amortization, you're paying it down at some level. What's your balance? Check out the amortization schedule. But here's one cool thing and one reality of how business happens today. Almost all the loans that happen today, across the board, have a very high percentage, say, have an interest-only period. Like I said, people, when they buy the building, need the most help. They buy a building with upside in the future. So many times the bank says, okay, here's what I'm going to do. I'm going to lend you money, 5-year loan or 10-year loan. First year or 2 years, interest only. But then starting in year number 3, then the amortization. You have to start paying it down.
Got it.
So now this calculator makes it very easy for you. 6.25 rates, 5 years, 30-year amortization, 1 year IO. It'll calculate what your payments are during the IO period, or payments afterward. You just have to know these numbers to plug in, and it starts doing all the calculations, and the magic works in there.
Perfect. So the loan term is how long I have my rate fixed for, and then I got to do refinance. Amortization is the math of, we call it a 30-year loan, is how my payments divided by. And interest only is that sometimes it's going to be a break. And so the first year, you only got to pay interest, and you pay up the rest later.
Correct.
Awesome.